Hello, I'm Michael Taila, Director of Fixed Income at City National Rochdale. Welcome to this month's edition of Fixed Income Perspectives. With the new year underway, fixed income markets are continuing to adjust to the effects of the Trump administration in a Republican-led Congress. This transition has led to notable interest rate sensitivity to federal policy reform, incoming economic data, and the actions of the Federal Reserve. Since December, the U.S. Treasury curve has experienced considerable volatility, with the 10-year fluctuating within a range of 65 basis points, as inconsistent inflation and labor reports have driven changes in investor sentiment. Despite this volatility, fixed income markets have benefited from shifts in the shape of the yield curve, with key segments reporting solid positive total returns year to date. For example, short duration has returned 41 basis points, while intermediate investment-grade corporates and municipals are coming in around 1%. High yield and opportunistic credit continue to outpace the pack in 2025. The Fed has communicated its intent to carefully weigh data against policy responses. If you recall, the Fed reduced rates by 100 basis points over 3 consecutive meetings beginning in September of 2024. After holding the overnight lending rate steady at the January meeting to a range of 4.25% to 4.5%, the FOMC is expected to maintain rates at current levels. Further easing will depend on incoming data and renewed confidence that inflation is headed lower. The futures market is currently pricing in one additional rate cut by year-end. CNR continues to forecast the Fed will lower the Fed funds rate by 25 to 50 basis points this year. Policy outcomes will likely become an important economic driver in the coming weeks and months. Recent tariff announcements by the Trump administration on countries such as Canada, Mexico, and China may further test financial markets and weigh on the economy. As U.S. trade policy evolves and Congress deliberates on fiscal reform in the federal budget, we anticipate further volatility while investors gauge the net impact. From a fixed income asset allocation perspective, we expect rates to remain elevated for an extended period of time as the Fed takes a more cautious approach to monetary policy. Yields across the market are historically attractive and could reward investors with compelling income and cash flow opportunities. We would be remiss not to acknowledge the potential for policy outcomes to impact fundamentals and market-based indicators. That being said, corporate quality remains broadly healthy, and a resilient U.S. economy continues to support this sector. With robust technicals and credit spreads near their historical lows, the market may not be fully pricing in policy risks that may lead to a weakening in future valuations. Tax-exempt municipal bond yields are also offering strong relative and taxable equivalent value. Furthermore, the municipal yield curve is steep, which enhances the income potential for investors extending portfolio duration. While overall credit conditions remain stable for the municipal market, we are closely monitoring federal tax reform efforts and how potential policy pivots could impact the quality, supply, and demand for the asset class. Thank you for watching this month's edition of Fixed Income Perspectives. Feel free to reach out if you have any questions.